Welcome on board then, Sandip Sabharwal, and find out what he's making of the market construct right now. Sandeep, hi, morning. Good to have you on the show as always. Volatile as it may be on Friday, but we did well towards the close. What's it that you've been doing in the past month or so in the market?
I think this is a market where, unlike a few months back, where I was saying that we should be cautious and not be investing so much, I think this is a market where every dip we used to use it to buy into stocks which we think are coming into a good value to growth paradigm because most negatives seem to be in the price now. And uh, there's a news today, unconfirmed, obviously, that the any tweaks in the income tax, etc., will be pushed back to next year. So I think that fear of some tax increase in the current budget also will go away. But markets seem to be reasonably placed. We need to just, if there's some dip, if there's some fall in some stocks which we think should do well over the long term, just buy them on dip days and keep on accumulating because firstly, no bear market is imminent, and secondly, markets did give a reasonable correction, and I don't see any big correction coming anytime soon.
Sandeep, what was the buy list like? And do you think those stocks are worthy even now if there were to be a dip?
Yeah, so I think when the market dipped, Bharti Airtel was something which came into reasonable valuation. M&M has been giving very positive growth guidance, so that fell, so that provided buying opportunities. Some banks, like even now, I think Axis and Kotak are at levels from which they could easily give double-digit returns over the next 1 year. L&T continues to do well, although it's near all-time highs. But during the dip, it provided good opportunities. Even now, I think it'll do well on the large cap side. And on the beaten down auto side, Maruti and Bajaj Auto have got beaten down substantially because of inventory sale growth concerns. So those have reasonable value at this stage, I would think.
Why Maruti, Sandeep? They are not going here, they are not going there. They have not moved to EV. The hybrid launches have not been great, and they're losing market share in their current portfolio. So, why Maruti is an exciting name to buy?
See, market share for a company which has such a huge market share is imminent because new players come in, so new companies have come into the auto sector, and they take away some market share. New models excite investor, consumers, etc. But despite that, I think they have done reasonably well. In fact, in managing the inventories and growth in a very slow market, they have done better than some other companies. And by first, the main issue was that they were not recognizing the EV transition, which they eventually embraced, and they have they started working on that. So I think they'll be having a few EV models also going forward. And the key is that whether you believe that auto demand will come back or not. So I think given the overall construct of the Indian economy, if we have a couple of years of slow growth, then eventually we'll have 2, 3 years of good growth also going forward. Raw material prices remain benign, and the value per vehicle in terms of sales has been going up, even though volumes have been subdued. So I think it's all a question of looking at the overall market, what valuation the overall market is at, and within that, which are the companies which trade at valuations at which you would like to buy them for double-digit kind of returns.
Okay. Sandeep, one stock which has lived up to its expectations is Reliance. And in this comeback, I'm only talking about this comeback for the market. After a massive underperformance, Reliance was technically looking strong that it should have come back, Sandeep, but it has failed to participate.
Yeah, so I think the biggest concern for Reliance always has been the lack of free cash generation, the new investment they continuously keep on getting into, etc. which is the reason I actually avoided buying Reliance for a very, very long time. But I think this time, after the 25% plus kind of fall from the top, I would think that most negatives are in the price today. And the refining business negativity, the worst of the profitability seems to be in the retail business negativity, in terms of the worst being in the price is in. And new business investments, new sectors are a concern, but they should be a concern for other companies also in the market. We see many startup companies in the solar segment or semiconductor. Whenever they announce that, their valuation move up crazily. So why should people be taking those investments by Reliance, which could be a much more credible player than these smaller companies, so negatively? So this I think current prices factor in most negatives, and even if Reliance goes back to where it was a few months back, over the next 18 months also, then also you get a 20% CAGR from a large cap, which is quite substantial.
Sandeep, let's understand what's next for the travel and tourism. Hotels have done well. Now you can say, okay, if you're a large cap guy, go for Indian hotels. You're a small cap guy, look for park hotels. That's how everybody's participating. But what else? I mean, if hotels are doing well, does it mean you need to buy travel and tourism, which is travel companies, Make My Trip, Exigo? Do you think now it's time to look at the other end of the basket?
The travel companies have been doing well, but offer very so uh, entry barriers are low. So and there are some global travel companies also. So these are just platforms, so people can go and buy these things anywhere. So they tend to do well transactionally, but I don't know what long-term entry barriers they hold. Indian hotels obviously is the example of how the right CEO can just transform the company, and also brings to question the entire, I think, debate or a separate topic, but process-driven organizations versus uh, process plus someone actually guiding you to do the right thing. So I think Indian Hotels has been a great story, and from whatever they are saying, they should continue to do well over the next few years also. Lemon Tree among this segment in the segment has underperformed somewhat because they don't actually benefit from these conferences, etc., and big events like marriages, etc. But they could also do well long term. The other, obviously, segment to play here is airline. So the credible player there is Interglobe Aviation only, and I guess they will also continue to do well over the years. On the entertainment side, the other company which we also keep on accumulating every time it falls, because I think it's a great management and long term. The only credible amusement player, park player in India is Wonderla Holidays. They have got hit this year due to uh, heat waves, occupancies being lower, and etc., and profitability suffered. But I think longer term, uh, they should do very well. And you can buy these companies, but they tend to be illiquid only when they are not doing as well. So I think this is something which could actually be a strong compounder for investors who are willing to wait for 3 to 5 years.
Sandeep, I think you mentioned last week that these EMS stocks, they look good. Now the point is that for the Sandip Sabharwal, I know anything above 50p, Sandip Sabharwal will be the first one to come out and say Mehenga hai, valuations are stretched. Why are you not blowing? Why are you not bearish on these stocks? Because 50, the P multiples I think are 50 plus, and the margins are 6-7%. That's not your style of investment.
Yeah, so not that I'm
पकड़ लिया
investing.
पकड़ लिया पकड़
So
लिया देखो पकड़ लिया पकड़ लिया. I've known you for long
no,
to catch you.
no, I'm not buying these stocks. But the whole point is that when the question was asked that whether these companies will do well over the long term, the only thing I see is that they are getting so much traction of growth by so many tie-ups and benefiting because of PLI, etc. And this the entire PLI business, because a few companies get selected, and then it's very tough for new companies to come in. So these people are getting sort of a moat because of government policies, not because of what they are actually doing. So I think that's the reason some of them could actually do well over the long term. That's what I said. So I'm not very comfortable buying them at these valuations and the kind of margins at which they operate. But the fact of the matter is that some of them could actually do well long term.
I mean, I was just discussing Sandeep this with Kunal that optically you look at these businesses, that's great on top line, but 2, 3, 4% margins. But look at the return what a Dixon or an Amber or even a Keynes Technology has given. We can endlessly argue about low margins, but the market in a sense have been rewarding these stocks as if there is no tomorrow. Where are these stocks headed? Let's say if somebody takes a 3-year view for Dixon, for Amber, can they double in 3 years?
I would think it will be tough because simply because of the valuation at which they trade. Like Dixon, I think trades at these prices, I would say 100 times earnings. So to sustain 100 times earnings, you need to grow at 50% for the next 10 years continuously. Whether they can do that or not, I don't think so. Whether if they achieve that, then maybe you will get return. So at some stage, you come to a level where returns obviously get muted. So you have to buy some of these stocks, whoever wants to buy on bad news. Like for example, Amber did not do well when the entire AC uh, market was in doldrum. So when the AC turnaround started to happen, for those who believed in these stories, they bought at that time, they would have made very good returns. So I think people need to wait either for an overall mid cap, small cap correction when these stocks normally fall more than the market, or due to some fall due to bad results, bad news, etc.
Sandeep, Swiggy, Zomato, not many options within that listed universe, but still sticking by with Zomato, or do you think Swiggy also makes a relook?
I think Zomato is much better placed if someone has to make a choice simply because they have, I think, cut down their cost structures in a manner that they are profitable. Swiggy is still on the uh, substantial negative profitability train, so they have still huge losses. How they turn it around is something we need to see. That said, given the intense competitive intensity now coming in into the quick commerce side, I would be cautious on the valuations of both these companies, especially Swiggy, but also Zomato at this stage. We need to watch out because stocks moved from 50 to 300, and at this price, most positives seem to be factored in.
Uh, Sandeep, any new exciting business which you are looking at acquiring? I mean, it could be small today, but it has potential to become large. Anything which is, let's say, outside the comfort of the large caps which we've discussed, or the obvious themes like travel and tourism. Anything which could be small today but big tomorrow, or anything like they say could be on the theme of catch them young and see them grow.
Very tough to say because if you look at the small and mid cap valuations, so we don't see that opportunity right now where one could say that such opportunities are available very cheap. Like they keep on coming up periodically, so I wouldn't, nothing is coming to mind as such as of now.
All right, Sandeep, really appreciate your time. Glad you could join us.
If you like this video, then like, share and subscribe to ET Now.